The funds have performed reasonably well year to date against a backdrop of weak markets. For example, both bonds and equities are in negative territory year to date, but they are behind their targeted outcomes of global cash plus 2.5%, 4% and 5.5%. The past 6 months is a short period over which to judge performance, however. Looking longer term, managed and growth are both comfortably ahead of their target outcomes over their respective investment time horizons of 5 or 7 years. Momentum Global Cautious is a little weaker of late, having returned plus 2.7% per annum over the past 3 years, compared to a target outcome of plus 3.5% per annum. The key detractors year to date have been our bias away from US equities, which have continued to outperform, and manager selection within fixed income. The key positive contributor has been equity manager selection, where we have seen a lot of success in the past 12 to 18 months. Our portfolios target 3 things. The first is the outcome, a return in excess of global cash. Secondly, we work to make the journey to the outcome as palatable as possible. And thirdly, we do those things because we understand how important it is to keep clients invested. When we position our funds, when we build them, we do so from a perspective of creating a portfolio we believe will give us the best probability of achieving these 3 outcomes. We've been busy with the portfolio allocations over the recent quarter. We added to the December 2023 US Treasury bond at the start of June. We decided to buy these directly and to target a specific point on the US yield curve because that's where we see the best value at the moment. The changes serve to increase the portfolio's duration, the interest rate sensitivity, but only modestly. Our central view is that interest rates will continue to gradually increase, and hence we expect to continue adding more government exposure as yields get attractive. And while many government bonds remain extremely expensive, US Treasuries now offer reasonable real yields. This in turn should mean they offer good downside protection in a risk-off environment, the chances of which can never be completely ruled out. We funded our purchases of Treasuries by reducing our US short duration high yield and liquid alternative positions. And while we continue to like both these asset classes, Treasuries are reasserting themselves as the ultimate event risk hedge at these prices. Also, in the past couple of months, we embarked on a cost-cutting exercise within the funds. We trimmed several managers and added passive components which tend to be cheaper, and we've taken up between 5 and 10 basis points of costs this way. For the first time since the financial crisis, safe haven government bonds, albeit only in the US to date, are beginning to offer an acceptable yield, and this will impact the way that other, riskier markets perform in the months ahead. Importantly, the global economy is in good shape as we enter a period of greater uncertainty and continued Fed tightening. The soft patch in Q1 is being followed by a pickup in growth through Q2 with generally strong or improving data. Leading indicators remain in expansionary territory, and there are few, if any, signs of capacity shortages and overheating that would push up inflation rapidly. A combination of steady growth, modestly rising inflation, and gradual monetary tightening is likely to keep bond markets under pressure, with yields rising further, but not to levels which would undermine equity markets. The underlying strength of global economies remain largely intact, and the pace of monetary stimulus withdrawal will be cautious. It's too early to be calling an end to this cycle ultimately. As we've seen throughout this long cycle, periods of marked weakness in markets have provided good entry points for longer term investors, and overall we believe it remains appropriate to stay invested, building greater resilience into portfolios through more defensive assets, while at the same time taking advantage of valuation opportunities as and when they arise.